of those various things. So for instance, that sales tax example, we take the sales tax data, we allocate part of it to business travel, we do part of it to personal travel, we do part of it to in-state residents, we use lots of different data sources to try to divide up these revenue collections. And then we compare it to personal income. So what we see here is that you all, this state and local tax burden, you all do stand out in your region. You have the 17th highest nationally, but you have by far the highest in your region. So what does this tell me? It tells me that compared to your neighboring states, more personal income in Arkansas goes towards paying state and local taxes than it does most other places. It's a sign to me this thing we've talked about a lot, that your taxes are high. Now, some of this you can't control. So your residents that go on vacation to Texas every year, they're paying taxes in Texas, right? You can't control that part of it. But when we break out the amount that's being driven by in-state taxes and out-of-state taxes, you all are, it's about 70 to 75% of this is being driven by in-state taxes. So we can't just blame Texas, we can't blame Florida, we can't blame Las Vegas. This is really being driven by your taxes, right? So this kind of goes back to this idea we talked about all along about the need to revisit your revenue streams to try to address some of this. And of course, we've had a lot of conversation about the data coming from ITEP. And I screenshot from one of Lisa's previous presentations. You guys have seen this chart a lot. This is their data on the combined state and local taxes based on income. Really, this is their measure of regressivity. As Lisa said many times, you all have a fairly regressive tax code. I agree to some extent. I think these numbers are overstated for a number of different reasons that I'm going to walk you through. So I would just use a bit of caution. I think the overall idea that there is some regressivity, particularly because of your heavy reliance on sales taxes, is true. But I think these numbers overstate the amount of that that's happening. So why am I saying that? First, the data that powers ITEP's analysis comes from what's called the IRS public use file. The IRS public use file is an anonymized data sample that researchers can purchase from the IRS and includes about 150,000 tax returns. So it's anonymized, trying to get a good representative sample. ITEP's model, the reconciliation model, is a bit unique in that it's able to produce state and local estimates. The Tax Foundation model cannot do this. The model from the Tax Policy Center cannot do this. The model from Penn Wharton cannot do this. The reason why ITEP is able to do that is because they used what was functionally the last year the IRS included state and local taxes in this public use file. That data, however, is from 1988. ITEP does a great deal of work to try to take 1988 data and move it into 2016, 2017, 2018. But that's still very difficult to do. Each state, each economy, this is very difficult. For comparison, the Tax Foundation Taxes and Growth Dynamic Scoring Model, we use the 2011 public use file. And we're actually not happy with that. We're trying to get we have a several lag on the IRS. We're in the process of buying more updated data from the IRS because we don't think that's good enough data for us to use for our model. And in fact, this is the conversation as to why we don't do state and local dynamic scoring, is because we are not comfortable using data from 1988. We would rather not do dynamic scoring for state and local governments than use data that we think, well, again, they're making great strides and they're trying to do this correctly. It's just very hard to do. Second is, I think their inclusion of federal tax policy is a bit selective. So why do I say that? So the data from that ITEP is presenting includes the impact of the federal, state, and local taxes paid deduction, which makes the tax code look more regressive because those that are taking that deduction at the higher end of the income spectrum. Those are the lower end of the standard deduction. So, but it doesn't include the fact that we have a progressive national data, so it's not Arkansas specific, but the trend would be very similar. The blue line is the ITEP data. We've taken out the impact of the SALT deduction on the green line. So again, it's still regressive, but it's not as regressive as it otherwise looks to be, because the effective tax rates at those upper income quintiles has increased. Those are the people that were taking the state and local taxes paid deduction. For comparison, here are the effective tax rates, again, showing how progressive our federal tax code is. On the right, the pink lines, this is the ITEP state and local data. On the left, these kind of bluish teal lines, this is the federal income tax. So my view is that you can't include one without including the other. You either have to include the impact of federal tax policy into your numbers, to include both the effective tax rates and the deduction, or you don't include it at all. It's selected to include one to basically lower the tax burdens at the higher income without having that offsetting effective tax rate calculation being added.
Nicole, but if they did that the same for every state, wouldn't it still be a valid comparison? Because you are treating them all as far as including state and local as well as federal.
Yeah, so in the comparison of states, all of the states are going to be biased in the same way. That would be correct. I would just say that it's overstating the regressivity in any one state.
So it may not be valid for actual picture of the burden, but it might be valid for a relative comparison.
Correct, yes. In addition, their analysis doesn't include all taxes. So I mentioned that the Internal Revenue, the U.S. Census Bureau releases 26 different types of taxes, which is what powers our analysis. They don't include all of them, particularly some of the broader-based business taxes.